Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at DealCatalyst. Joining me today is Matt Edgar, founder and CEO of Edgar Matthews. Matt, it's great to see you once again. Thank you for your continued support, and of course, thank you for your time today.
Of course, happy to be here.
So just to kick off, and I think this will kind of give the audience a little bit of understanding of kind of where we're taking this conversation today. Valuation, has been a pretty hot topic the last few years, especially during COVID, where we saw kind of valuations go bananas in late 2021, and then they kind of came what seemingly have come crashing down. From those highs, they seem like they've kind of been on a roller coaster ride the last few years. Have we settled into what we would think is a more normalized environment, more stable? Kind of where would you say valuations of, especially lenders and fintech lenders, specialty lenders sit today?
I think it's a great place to start the conversation. And I'd say today the environment feels much more rational. And I think another way to phrase it is the bar is higher, right? So there's a clear delineation between high quality platforms with durable earnings and scaled origination versus businesses that are still proving themselves. And I think that sort of bifurcation is helping bring some discipline back into pricing. In the context of M&A, I think we're seeing a strong bid, particularly for commercial finance companies right now, which is driving strong premiums for high ROE scaled platforms. There remains a bid-ask spread, I'd say, in the context of M&A, but we have seen a handful of situations in either ABL, equipment, SME, or factoring with 50 to 60% premiums to book value in some cases. I'm sure we'll spend some time later in this conversation kind of talking to what drives those premiums, but that's definitely, I think, a healthy but measured multiple for the right assets. Taking the view from the consumer side of the market, this is really issuer specific. I know you mentioned fintech. A lot of the consumer platforms tend to leverage or try to leverage technology more than the commercial side. So look, just this morning you saw SoFi out at Sun Valley on CNBC talking about some of their growth. That stock is up more than 30% year to date. And you're seeing some of that momentum translate into private markets, which is where we play as a firm. But there is much more noise around consumer finance due to some of the regulatory uncertainty, some of the high standard deviation and vintage losses, and sometimes a questionable sort of value for the technology that they're implementing.
If we look at it maybe in a little bit of a one-on-one as we kind of get through the conversation here, how is value determined for specialty finance / loan originators, and kind of what multiples or approaches are deemed most relevant?
Yeah, so I guess taking this in a couple of different ways, the approach for valuation really varies by asset class, business model, and financial or I guess profitability model. You can't just throw a book value multiple on every specialty finance company. And I think the key really, or the art, is adjusting for normalized loss rates and prepayment speeds and cost of service. Staying away from really just looking at LTM earnings. And I think valuation really starts with understanding the business model of the target, meaning is this a balance sheet driven traditional finco, or is it more of a origination platform that is balance sheet light and more fee oriented. As most folks well know, fincos are the more popular business model that has historically been applied to specialty finance companies, and sort of the majority of what we see. And I think the biggest input for these types of businesses is really what is your return on equity? If someone was to ask me to estimate the value of a platform with the use of one single metric, I would ask for return on equity. Premiums and discounts can obviously be driven by credit performance, scale, funding advantages, growth rates, and a number of other metrics. And I think also it is dependent on the specific vertical that you are playing in, because also the buyer mix, which we'll get into, determines sort of the view on fair value. And I think beyond just measuring something sort of on a book value approach, depending on the scale and maturity of the business, triangulating around some earnings-based multiple or premiums to portfolios, which is really an adjacency to a book value approach, I think makes probably the most sense for a lot of the traditional fincos. Now, for the platform originators, we typically see these valued on some multiple of, called adjusted EBITDA or operating margin. And for some of the earlier stage, more fintech type of folks, the revenue multiples is what most folks sort of do focus and key in on. And I think a lot of the inputs are the same around growth, diversity, things like that. The last comment I would make, and this kind of gets to the composition of the buyer base, private equity sponsors have been increasingly active in looking at balance sheet heavy specialty finance companies. So those funds are unsurprisingly very focused on IRR. So oftentimes when we're engaged to sell a business and we're interacting with a large sponsor universe, we will sort of set an IRR at low to mid 20s, whatever we understand the fund is sort of targeting, and back solve the price that they can afford to pay to hit that IRR. So you're sort of back solving into ability to pay, which is a super relevant metric, but also, as I mentioned, depends on who you're actually marketing a platform to.
What drives premium valuation?
Yeah, so I think in addition to probably the more obvious characteristics I mentioned in my previous response, I'd say a couple of things. Data and infrastructure is hugely important. I think the efficacy and also the history of your data and reporting systems, obviously asset-backed finance and specialty finance are heavily data-driven. So having not only clean loan tapes, but clean loss curves and ability to measure CPR historically, and these key almost securitization metrics are also very relevant in the context of M&A. So I think that's quite important. Buyers do tend to place a premium on platforms with what I'll call proprietary underwriting engines. In our experience, because the company calls it proprietary, we sometimes disagree that it is indeed proprietary. But if there's real technology underpinning underwriting, I think that's really interesting and something that we've seen buyers are willing to pay up for. And I also think from just a customer acquisition perspective, particularly on the fintech side of the equation, there's a lot of platforms out there that are still reliant on paid channels. So cost per lead or cost per prospect is quite high and rising. So if there's some moat or competitive advantage around sourcing the end customer, I think that's quite interesting. And the other point that's becoming increasingly topical or important to an underwrite is just the, I guess, regulatory visibility and durability of the business. There's been a ton changing in alternative credit, alternative finance based on the latest political backdrop in the US, obviously. So that's created a lot of uncertainty. I mean, you saw the noise around the litigation finance space with some of the bills coming out that, as of this recording, seems to be sort of corrected or rectified, which is good to see. But this constant change, I think, has led some folks to haircut businesses that are more exposed to regulatory risk, I'll say. So that's becoming much more front of mind in a lot of negotiations that we're involved with.
So I know we've kind of touched on fintech a little bit, and it's a world I used to cover and essentially come from in many ways.
Yeah.
But the profitability piece of this has seemed to escape a lot of fintech lenders. Ultimately some of the I'd say two of the biggest, most well known, ultimately bought banks, which made them profitable, both Lending Club and SoFi. Is there anything particular that um, is it the business model? A lot of it you referenced paid spend, a lot of dollars going into marketing, balance sheet light. I mean, is it a fundamentally flawed way to build a business?
I don't think so, but I do think there's a lot of noise, a lot of competition in the space. And I think the best way to summarize it is we're still kind of enduring the hangover of growth at all cost mindset amidst zero interest rates, right?
Yeah.
So from a business model perspective, I mean, there's some structural disadvantages that fintechs have relative to ignoring banks. I mean, non-bank balance sheet heavy loan originators, right? I think from a uh, customer acquisition costs, I kind of hit that already, but that is sort of a big area of focus and innovation. Folks that will be able to solve that hurdle, I do think will be able to succeed at the expense of peers. Um, the other thing in fintech also is the brand loyalty for these businesses tend to be quite low.
Yeah.
And as the space becomes more crowded or competitive, depending on how you look at it, um, amid switching costs as well reducing, I think that has given way to a oversupply of businesses and not enough room for folks to be all be successful. And I think also you hear fintechs constantly pitching the idea of cross-selling opportunities. There's been a pretty small universe that has successfully been able to cross-sell different loan products to existing consumers. I think that is really I don't want to say holy grail, but the core target of many lending businesses, but the path to getting there can be quite difficult. And then I guess looking on the other side of the balance sheet, fintechs are at an inherent funding disadvantage too. To your point, I mean, most of these are running unprofitably to a certain point. I'm kind of focusing on the earlier to mid stage type of businesses.
Yeah.
But even for recourse financing, if the servicer is not profitable, that will indirectly influence financing costs to some degree if servicing isn't house, right? So I think that sets up sort of a disadvantage relative to a better capitalized FinCo structure. And the last point I'll mention that I think has been flawed over the past few years, I'd say, in fintech is prioritizing quantity over quality. There's been a lot of mispriced risk just sitting on these books, again, with the ethos of grow at all costs.
Yeah.
So this is also compounded by, and there's a lot of businesses doing great work in this space, but a lot of the fintechs are using AI or ML driven underwriting tools today, some of which will become market leading software applications. But I think the less proven, less seasoned tech enabled underwriting can have the risk of unearthing issues when it's already too late. So I think that's another point when you couple with the growth at all cost mindset for loan originations that creates some problems on the credit side.
Tell us a little bit more about your firm and when telling us, I mean, what ultimately led you to say, "Hey, I
Yeah.
want to become a founder. I want to start my own shop."
Yeah, so I guess the first part of that question, so just to give an overview. So we're a sector focused investment banking firm. We exclusively focus on the financial services sector, and we think about, I guess, the services or products we offer across three main buckets. The first being strategic advisory, largely buy side and sell side M&A work. Do some work with joint venture advisor, and we also advise boards and management teams on a number of non-transactional matters as well. Um, the second bucket is kind of what we refer to as private capital markets. This is our unrated financing business, so focused on raising debt, equity, structured equity, forward flow facilities for platforms operating in our spaces. And then the third bucket is what we call insurance solutions. That's our rated capital markets business. So we do mostly private ABS deals and securitizations, rated corporate financings, rated feeder funds, and really any other esoteric capital markets deal where we can leverage our close ties with life insurance companies on the investor side, which are the largest consumers of that product that we actually bring to market. So in terms of the firm, we're fairly new. I launched it about 2.5 years ago at this point. We're now a team of 10 bankers. We've closed 12 deals, which we're pretty proud of. And our focus right now is really to continue bolstering the team. We've been slower to hire and very intentional to hire. We focus on a pretty niche space, so figuring or finding the right individuals to fill those seats just takes time. So we have some pretty good momentum. I think our focus is really to build capabilities in other areas of financial services as well. As you know, Todd, I mean, we spend tons of time in specialty finance, but we have aspirations to grow into other verticals across FIG as well. And I guess on the personal side, I mean, in terms of what led me to start the firm outside of just having the entrepreneurial bug, I suppose, we identified a pretty significant white space, I think. I came from a bulge bracket investment bank. You see the headlines of bulge brackets often citing the desire to start to go down market and cover middle market companies, but they're just not set up well to do it. It's a lower margin business for that. So you typically get the B or C team at the larger firm working on a smaller transaction, which can have potentially adverse consequences for the company. So we think we can bring sort of the capabilities and sophistication of a big bank into this lower to mid-market area. And I think also covering financial services, the sector in and of itself has a completely different approach to valuation and modeling and understanding business models. So it's not, you can't throw a consumer or retail banker into a financial services transaction. So that level of specialization, I think, has helped us quite well. So it was really identifying that white space, like I said, and we believe we've created services that cater to businesses that are migrating up the maturity curve in alternative lending. And I can't say I knew this before launching, but the past 18 months since we've launched, asset-backed finance has been on a complete tear.
Good timing.
It's in every headline. I wish I could say I predicted that, but that's certainly giving us some nice tailwinds in growing the business. So we're quite proud of what we're building, but still very early innings. So,
when it comes to financing mix and capital structure, how does that impact valuation? And kind of thinking back to the question we were talking about before on fintech and maybe some of those earlier platforms, are they aware of kind of what that right funding mix and what the capital structure should look like?
Yeah. So I guess on the second point, I'll hit that first, actually. Fintechs are fairly sophisticated when funding their businesses. Given most of them are VC-backed, they grow their teams quite quick. So it's not uncommon, even in earlier stage fintechs, to see a head of capital markets or chief capital officer as one of the pretty early hires. So that leads to a certain sophistication. I think it's really about access in absence of having track record, vintage data to show payoffs and get lenders sort of comfortable with the performance of the underlying asset. And from a valuation perspective, I mean, having a funding advantage certainly supports a premium. So if, a originator or specialty finance company, I'll refer to just universally, has, locked in non-dilutive long-term forward flow or securitization capacity that compresses their cost of capital, signals scalability, and a lower cost of funds, obviously, widens their NIM, directly boosting equity value. So that's sort of the mathematical approach. I think platforms with, non-recourse securitization often trade higher as well due to like lower refinancing risk and covenant risk and things of that nature. So there's multiple benefits of getting to securitization. And oftentimes when you're speaking with platforms, the playbooks kind of get, in its simplest form, private credit fund, non-bank lender. Maybe you do an A/B structure with a private credit fund and a bank. You eventually refi to only a bank, and then you tap the securitization market. So that's kind of the playbook that we see, but plotted on the axis underneath that is sort of, the maturity of the underlying business. And I will say one thing that has come up as well in recent conversations that kind of relates to this is a buyer will haircut valuation for what I'll call inorganic NIM. So if net interest margin is a function of, capital inefficiency rather than pricing power or performance, I think that will also impact the ultimate price that would be paid.
You referenced earlier the buyers. I'd love to dig a little into what do the buyers look like today, and has the composition today, how much has it shifted from say 12, 24 months ago?
Yeah, that's one of the biggest trends that we've seen, frankly. So winding back the clock, historically, starting and scaling a specialty finance company and selling that company to a bank was nirvana, right? Banks, by
Yep.
definition, should be able to pay the most through revising cost of capital down to deposit rates versus, third-party warehouse financing.
Mhm.
Starting post GFC, there's been an accelerated focus with the recent community bank volatility in 2023. But banks have been shedding specialty finance assets for years at this point. There are pockets, I don't want to speak on behalf of all banks, because there are pockets of banks seeking to grow exposures, but it's more idiosyncratic, strategy specific.
Yeah.
Private equity sponsors are still active, as I kind of mentioned earlier. I'd say interest is slightly up from 12 to 18 months ago, really on the back of, again, ABF being topical, and we've seen probably less aggressive pricing from outright private equity sponsors. Filling the gap, though, are the private credit platforms or private credit focused sponsors, for lack of a better term. There's obviously been trillions of dollars raised in direct lending. You know this very well at DealCatalyst, obviously.
Yep.
And the space is getting increasingly competitive. In the core middle market cash flow product, spreads are going down, leverage is trending up. And I think a lot of these players are seeking to augment these cash flow exposures with more asset-backed exposure. So I made a comment earlier, valuations in commercial finance in particular are becoming more pronounced. And that's a function of the private credit players. Commercial finance, they're business to business lenders. It's a much more natural place to start for a private credit platform looking to get into specialty finance rather than buying, a consumer platform, which is a much different underwrite versus what they're already doing in broad middle market credit. I would, though, mention that with the intersection of insurance capital and private credit, on the consumer side, we are seeing a lot of interest there, but that's really been taking the format of more forward flow purchases or some structured liquidity solution. So I think private credit has really picked up a lot of the, call it, slack that banks have kind of left in the market. And I expect dialogue between asset managers and specialty originators to continue to accelerate. And we're certainly seeing that play out in real time.
What would you say the transactions themselves look like, say, versus what we consider a traditional M&A deal? Is there any special, considerations that you're seeing in transactions today versus maybe the traditional version?
Yeah. So in terms of the all stock, all cash for control M&A situation, which there are certainly still those transactions happening. But from our vantage point, we're kind of seeing deals manifest, I guess, in a couple of ways. One is joint venture types of structures where a partner capitalizes a sidecar origination vehicle, owns most of the economics in that vehicle, typically with some co-investor first loss capital provided by the originator for incentive alignment. And they may take a minority interest in the originator and help build equity, I guess, at the management company through either fees or other economics being put back to the originator in that sidecar. So that's one structure that we've seen pretty commonly, I'd say, over the past couple of years rather than in recent months, but worth noting. De novo builds are sprouting up in a number of different asset classes. And we actually think this is pretty interesting from a buyer's perspective, given some of the run up in certain asset classes, in multiples in certain asset classes that we're seeing. De novos provide an avenue to enter an asset at book value versus potentially paying a significant premium. So there's been a number of successful de novo builds historically. We're seeing quite a few sort of sprout up, as I said before. And we think that's kind of an interesting way to get exposure to the space if it's a credible team that you trust. There's also junior capital trades, which we've come across as well. Structurally, and look, these can take many different formats, but to give an example, maybe it's structurally you're in a downside protected instrument via some sort of preferred or sub debt, but functionally you're acting and controlling the business like majority equity. We've seen some of those before. And I'd say the other one probably more relevant for the fintech players or the hybrid fintech and traditional players is asset plus tech deals where maybe a buyer effectively will purchase the IP of software or servicing capabilities that you're producing and almost do a sale leaseback where they'll give you a beneficial deal on that software, but they actually own the IP. They'll maybe buy a minority stake in you as well, but the originator keeps the production. So I think that degree of optionality has been, very apparent, and folks aren't open to just taking blind risk. And again, we've probably seen this a bit more on the consumer side, where portfolio volatility, I think, has made acquirers, generally speaking, more cautious in the space.
You've piqued my interest with the de novo. What exactly is that? I mean, I know the term de novo, what that means, but like, what do you mean when you say that?
A spin out almost, right?
Okay.
So we've seen single individuals or teams leave large established platforms, take some origination capability with them, and start something anew from scratch. A number of the BDCs have actually successfully backed a few de novo platforms where they'll sort of fund some of the upfront burn, but really provide that haircut equity to enable a effectively startup platform secure senior financing. And I think in these situations, unlike investing in a non-financial service startup, the path from 0 to 1 is much more clear, right? Because provided you can get senior financing, scaling to a loan book of 100 million, 150 million can actually be done quite quickly if you have quality originators that can find that business.
Yeah.
Because advance rates can be pretty efficient depending on the asset class. So getting the capital to do that is much more clear versus writing $150 million equity check into a startup, which doesn't happen, but using that as an example.
What asset classes are, kind of seeing the most interest right now?
Yeah, so as I mentioned, I think commercial from our perspective is definitely bigger, and that's sort of playing on that private credit trend as more folks seek to enter into asset-backed or specialty finance. Worth noting on that, we're seeing a significant number of factoring platforms seeking to exit. That space is very fragmented, so there's a high volume of subscale platforms, and us as a firm don't feel super well equipped to advise very subscale platforms in that context, but we certainly see a lot of flow in that space and know they're out there. Again, I think the tech-enabled players are more brand specific. There is some distress, I guess, in that space, but I think the focus there is really the path to profitability and how real that is. And I don't see much of a bid for, again, subscale originator has unproven tech looking for some gross premium to book or multiple of revenue. I think also on the positive side, near prime and prime unsecured consumer is definitely interesting. But again, as I mentioned, you're seeing most of the strategic dialogue there really take the shape of large forward flow purchases versus outright acquisition. But in theory, there should be consolidation to come in that space with a number of new, more niche lenders sort of growing in consumer unsecured. We just haven't seen a significant pickup in that, again, from our seat just yet.
One thing you touched on earlier, one of the answers was the regulatory risk and whether or
Yeah.
not that's being priced in for consumer lenders. And obviously we've seen changes at the CFPB, other regulatory bodies. Kind of how does the regulatory piece play into this? And as kind of a follow on to that, how does that dynamic at the federal level
Yeah.
balance with what's happening at the state level? Because there are states that kind of pick up where they think the feds might be leaving room for others to exploit.
Yeah, that's completely right. So in terms of the regulatory risk dynamic, how that impacts pricing in context of M&A, we're definitely seeing haircuts be applied to ability to pay. platforms in states like California, Colorado, Connecticut are, may be priced at a discount if their compliance frameworks aren't fully built out. There's, true lender doctrine, there's APR caps, there's the Madden risk. All of these are becoming more heightened, again, just given some of the uncertainty around it. I think post CFPB, we sort of are not necessarily seeing, but a lot of our clients are expecting more litigation-driven due diligence. I think buyers probably will ask for heavier indemnities and reserves or escrows for sort of regulatory lookbacks. And I think, look, some smart buyers are even pricing in expected compliance capex, where the, I guess, investment to comply with certain laws is expected to be heavier. So that will be expressed by them putting up the capital, but with a lower multiple, I guess, in context of purchasing a business. And in terms of the state dynamics, I mean, state regulators are stepping into the vacuum, I suppose. We're watching states like California, New York, and Colorado become de facto federal regulators in consumer finance, because they're the ones really setting standards on APR caps and disclosures, and algorithmic underwriting is a big focus right now. So for lenders sort of operating across geographies, this creates, I mean, folks kind of call it a patchwork of compliance burdens that can impact OpEx. And I think that's, taking some time for folks to digest. And I think the net result is that, I mean, investors or acquirers are going to favor lenders with clean compliance track records, have a mature, dynamic legal infrastructure in place already, and also have the ability to sort of navigate both regulatory regimes. But the bar is definitely higher, and what was a important but less front of mind focus in negotiations is now very much front of mind. So we've been spending quite a bit of time working with clients, often in conjunction with lawyers on that.
What about the possibility of kind of the high interest rate lender coming back? And do you see that as a possibility? Or have we kind of competition has mitigated some of this, regulatory has mitigated some of this? What about that high interest lender?
So I think you're still seeing them out there. They're just not expressing their return as an APR. So I think you will see the return, not just because of credit and regulatory tightening, but because capital is demanding yield right now, right?
Yeah.
Whether it's subprime installment, secure lending, or some niche vertical like lease to own being a perfect example, I think investors are warming back up to that risk as long as it's well structured and, I'd say, priced appropriately for today's market.
So I'm curious, could you walk us through maybe why someone would buy a loan book versus an originator, and kind of how does that decision ultimately get made?
Yeah, so I think it's a couple of things. The loan books, I don't want to say tend to be easier, but they tend to be less committal. I mean, they're committed capital, but there's a number of outs or stop funding events typically. If performance falls off a cliff, there's some breach of covenants, the servicer goes bust. So I still do think that those are viewed as more of a capital markets trade. In my view, if I was an investor in a forward flow, I would perform the same level of due diligence and scrutiny as I would if I'm making an equity investment or acquisition of a platform, which I think most savvy investors do approach, but understanding structurally, it's probably lower risk or less committal than a bad acquisition that you then have to unwind. So I think that's one piece of it. Procedurally as well, there tends to be slightly less diligence friction, I'd say. Because of that, you don't have to spend much time on integration in terms of headcount, tech, and any regulatory baggage that you're sort of coming into. And forward flow or loan book purchase agreements can be a very powerful tool to scale. You're seeing insurance companies and insurance-backed asset managers write billion-dollar checks plus in this type of structure, and that's a very efficient way to get rated assets on the book. So you're seeing the credit funds, the insurance companies, and then also the BDCs, I think, again, are kind of an interesting party here because depending on what the loans look like and if they can be deemed eligible for BDCs, it's again a very efficient path to scale. I think from a M&A perspective, again, it's going to be much more strategic. From a strategic buyer, less sponsor-driven purchase, it's determining whether this can help unlock some of the cross-sell opportunities that I mentioned before. What's sort of my book value earn back period on the investment I'm actually making? Retention tools are much more of an area of focus. Getting the integration right, as I mentioned, the opposite is very important for M&A. So I'd say more transformative, clearly, is doing outright platform acquisitions, but loan books are providing an interesting path to that. And by the way, purchase of a loan book or a forward flow agreement can be the first part of an acquisition, where buying the loans, understanding how the collateral behaves, gives you a very nice view into the ultimate platform that you're buying. So we have seen some of those, call it like two-part transactions, where it's kind of relationship through forward flow or whole loan purchase, and then with the ultimate expectation that we want to integrate and own this platform.
We've spent a lot of, and we just have a few minutes left before we get to our fun questions, and then we're out the door.
Well, these are fun too, Todd. So,
well, from my perspective, certainly, but a little more personal fun questions. But we've talked a lot about obviously some of the benefits, where the market is. One thing we haven't yet touched on is how might buyers either get burned on deals, or if something goes south, kind of what happens, what's the recourse? Maybe we can delve into a little bit about the negative side of some of this.
Yeah, so contrary to popular belief, it's nothing non-obvious, right?
Yeah.
So it comes down to a couple of things. I think overestimating what I'll call lifetime value. Static pool assumptions can be misleading. One bad vintage or unseasoned book with front-loaded promotional terms can destroy IRR when the promotional terms end. So I think, again, that estimate of lifetime value is a big error that folks can make. Hitting regulatory, just unpriced regulatory liability, I think the expectation you're inheriting some degree is probably appropriate, but that needs to be priced correctly. If not, we've seen some blowups in negotiations, at least, sort of relate to that. Servicing risk is another one. If servicing is subpar, especially in distress, you'll see elevated delinquencies, lower recoveries. It's not about origination alone. So that's something that folks should spend a lot of time on. And also just poor capital match, right? Some buyers fund long duration loans with short duration capital, and we all know that never works out well. I'm still shocked that so many platforms insist on doing that. So that's especially common, I'd say, with newer entrants trying to mimic warehouse structures without understanding the traps of over collateralizations and mark-to-market triggers. But that's another pretty common one that we see.
So as I mentioned, the personal fun questions, at least, as we wrap up here. So do you have a favorite sports team and or hobby?
Sports team. I grew up on Long Island. Long history of Jets fans. Not by choice, but New York Jets is probably the sports team I follow most closely, unfortunately. And hobby-wise, I'm an avid runner. I like to cook. I travel a lot. And work and spend a lot of time building my company as well, which is a hobby. So,
well, certainly it's funny because I grew up in Long Island, still live here, and I became a Bills fan. So,
you're a smart man.
I don't know about that. We might just get tortured as we get close. You guys don't necessarily get close.
The expectation couldn't be lower, so it's tough to get too upset, I guess.
Tell us one surprising thing about yourself.
Staying with the football theme, I was the kicker on my high school football team.
Interesting. One book you'd recommend reading?
Well, I'm going to do two because I do read a lot of business books. So I'd say, as a banker, The Trusted Advisor is probably one of the best books I've read around my profession. I think I read it when I was an analyst, but definitely a good one. And I guess a more fun one, this is also somewhat related to finance, I guess. I am late to the party, but I just recently read Red Notice, which is incredible. It's, again, finance related, but read like a movie, and that's probably the best, one of the best, more personal books that I've read recently.
Most exciting part of your job?
I think it's really just solving problems for clients, right? This business is transactional, but every call we get, our client is having some corporate finance challenge, and it is our job to find a solution to that challenge. So sure, it's M&A, it's capital raising, and that's usually the solution, but approaching it with kind of a blank slate is incredibly rewarding intellectually. And I think also just building meaningful relationships makes the job fun. I mean, some of my clients I've been working with for close to a decade at this point. So you grow friendships and get to know folks beyond just the office, which again, just working with great people that you know super well makes the job a lot more enjoyable and fun.
And then one prediction for the next 12 months.
I assume you want a business prediction. So I'll say,
yes, definitely not Jets in the Super Bowl.
I'll say, keeping with the M&A topic, I think acquirers will prioritize, I think, vertical integration. So snapping up originators or servicers that reduce funding friction, enhance data visibility, or unlock some other path to a rated issuance or other capital markets issuance. I think also partnerships with alternative asset managers and private credit funds will kind of lead that charge. So they're no longer, I think, being content being more passive capital providers to the space. They want to own platforms. And I think that upstream ownership of origination will drive more significant manufacturing of credit. And again, I think you're starting to see that with a lot of the transactions that have publicly announced. So that's sort of my take. No crystal ball, but call me in 12 months to see if I'm correct.
Well, Matt, I really appreciate you you coming on the show. Thanks for your time. Thanks for your continued support for some of our events. Been great to get to know you, and appreciate the time today. Continued luck to you and the team.
Likewise, thanks so much, and looking forward to the Asset Back Conference in September.
Well, thank you. And, free plug there. Check out DealCatalyst.io for all the details for our ABF conference in September. Thanks again, Matt.
Thank you.
Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.